What if your investment could outpace the average market returns while still maintaining a robust risk management strategy? Now consider the importance of the right fund. We'll focus on a standout performer in this category, the JPMorgan Large Cap Growth R6. With its impressive track record, it offers a vivid example of what large cap growth funds can achieve. And see how it stacks up against its peers. Dive into the JPMorgan Large Cap Growth R6, a contender in the large cap growth category. This robust fund stands out with an expense ratio of 0.52%, allowing investors to keep more of their gains compared to funds with higher fees. Let's look at the performance metrics. JPMorgan Large Cap Growth R6 boasts an impressive annualized return, or compound annual growth rate, of 16.81%. This figure indicates a strong potential for growth over time, turning an initial investment of $10,000 into a striking $42,656. The volatility of this fund, measured by its standard deviation, is 18.33%. This suggests a moderate level of risk, though it's somewhat higher than the average for large cap funds. In terms of specific yearly performance, the fund had its best year with a remarkable 56.42% gain. Conversely, its worst year saw a decline of 25.21%. Risk-adjusted returns are crucial for evaluating fund performance. The Sharpe Ratio here is 0.86, indicating that the fund provides a reasonable return per unit of risk. Even more telling is the Sortino Ratio at 1.46, which suggests the fund performs well in negative market conditions, focusing on downside volatility. With these figures in mind, how does JPMorgan compare with other giants in the field? Let's find out. Investment choices abound, but how do they measure up when placed side by side? Let's start by examining the expense ratios, a critical factor influencing net returns. The JPMorgan Large Cap Growth R6 carries an expense ratio of 0.52%, which, compared to its peers, is on the higher side. The Fidelity MSCI Information Tech ETF boasts a remarkably lower expense ratio of 0.08%. Meanwhile, the Schwab US Large Cap Growth ETF and Vanguard S&P 500 ETF offer even lower expense ratios of 0.04% and 0.03%, respectively. Lower expense ratios can be particularly attractive for cost-conscious investors. Turning our gaze to annualized returns, the Fidelity ETF leads the pack with a robust 19.09%, followed by JPMorgan's 16.81%. The Schwab ETF and Vanguard S&P 500 trail with 15.10% and 12.03% respectively. While higher returns might catch the eye, they often come with higher risks. Indeed, risk profiles, as indicated by standard deviation, reveal that higher returns come with increased volatility. Fidelity's ETF has the highest standard deviation at 19.87%, while Vanguard's ETF shows the least volatility at 15.65%. JPMorgan and Schwab's offerings sit comfortably in between. Diving deeper into performance metrics, JPMorgan shines with the highest best year performance at 56.42%, yet suffered a significant drop during its worst year at negative 25.21%. Fidelity, while almost matching in best year performance, faced a steeper worst year loss. Schwab and Vanguard, with lower highs, also had less dramatic lows, suggesting a potentially smoother investment journey. Maximum drawdowns further illustrate this point, with JPMorgan, Fidelity and Schwab experiencing sharp declines during difficult periods, while Vanguard's maximum drawdown was notably less severe. Understanding these comparisons can illuminate which fund might align best with your investment goals. Higher returns often come with higher risks, but is the trade-off worth it? When investing, it's not just about the gains. Understanding the risks involved is equally crucial. That's where the Sharpe and Sortino ratios come into play. The Sharpe ratio measures the performance of an investment compared to a risk-free asset, adjusting for its risk. A higher Sharpe ratio indicates better risk-adjusted returns. The Sortino ratio, on the other hand, focuses only on the downside risk, which is more relevant to investors who are concerned about sharp declines. Let's delve into the numbers. The JPMorgan Large Cap Growth R6 boasts a Sharpe ratio of 0.86 and a Sortino ratio of 1.46, reflecting a reasonable balance between risk and return. The Fidelity MSCI Information Tech ETF shows a slightly better profile with a Sharpe ratio of 0.91 and a Sortino ratio of 1.53, suggesting more efficient management of downside risk. Comparatively, the Schwab US Large Cap Growth ETF and the Vanguard S&P 500 ETF present lower ratios, indicating less favorable risk-adjusted returns. Balancing risk and return is critical. Let's summarize our findings to see which fund manages this balance best. Now that we've explored these investment vehicles in depth, what have we learned? JPMorgan Large Cap Growth R6 stands out with a robust annualized return of 16.81% and a relatively high Sharpe ratio of 0.86, reflecting decent risk-adjusted returns. However, it also bears a higher expense ratio of 0.52% compared to its peers, which could affect net gains. Despite this, its performance in terms of growth and resilience in volatile markets is commendable. Armed with this knowledge, you're better equipped to make informed decisions that could potentially enhance your investment portfolio.